Hello and welcome to another one of our Satrix collaborations with BlackRock's iShares, where we discuss investment trends, macroeconomic themes, and more. We're very fortunate to have Varia Pechurina with us today, and we're going to be discussing a lot of things. So, Varia, I'm going to kick straight off and ask you a very broad question. So, a lot is happening currently on the global macroeconomic front, with many fearing the Trump administration may look to weaponize the dollar through trade and tariff renegotiations, while regional wars look set to remain an ongoing fixture for some time to come. Now, what is BlackRock's view on the broad macroeconomic regime that we're currently in?
That's a great question. And in fact, we believe that the volatility year to date is not a one-off event, but rather it's a symptom of a broader regime of macro and market volatility that we're in right now. And we believe that there are three structural drivers of this volatility that are here to stay. You've obviously mentioned policy uncertainty. It's one of them. The second driver is mega forces, so long-term trends that are affecting markets now and causing volatility. And sticky inflation and higher for longer rates that we expect over a strategic horizon. And maybe if I share some color on each of these drivers, starting with policy uncertainty. In the past, policy was almost like playing a role of market stabilizer. But right now, the roles have flipped. It feels like the markets are serving as a force that are stabilizing policy. We have seen it with the UK mini budget. We're now seeing it with tariffs, with markets reacting negatively to tariff headlines, and with the hope that this may reverse some of the tariff policies that are happening right now. On mega forces and long-term structural trends. So, first of all, what are the mega forces? These are long-term developments that we expect to affect the returns of financial markets over the strategic horizon. And we at BlackRock define a number of mega forces, such as AI, low-carbon transition, geopolitical fragmentation, aging demographics. And the thing is that these long-term developments are fueling investments into the real economy and are already being reflected in financial markets. For example, all of us remember the stellar Magnificent Seven rally that took place last year. But also, all of us remember that we were asking ourselves questions. How much is in the price? Are earnings going to grow? Is capex too excessive? And this goes to show all the difficulty of projecting these long-term developments into the near term. And as a result, as investors reprice these expectations, this may cause volatility in markets. And finally, on the third driver that I've mentioned, sticky inflation, we believe these mega forces that I've mentioned will be inflationary in nature and will be underpinning the sticky inflation over the strategic horizon. For example, geopolitical fragmentation and low-carbon transition. This implies companies rewiring their supply chains, changing their operations. This is inflationary. Aging demographics in many developed markets means more restricted labor force. This is also inflationary in nature. Even AI, over the long term, yes, it may be deflationary if we assume that AI is widely adopted and productivity is improved off the back of this. In the near term, though, as AI infrastructure gets built out, we may run into power shortages, for example, and that may be inflationary. And what's the link of these developments towards volatility? Well, if central banks now need to focus on inflation more than in the past, they wouldn't be able to cut rates as much as they did before. And as a result, this can contribute further to the volatility regime that we're in right now.
So I'd definitely like to come back to rates and central bank actions and the like. And you mentioned a few very interesting points there, specifically one that policy reacts to markets and that kind of equation has been reversed. That's a fascinating insight. And I think I can't agree with you more that policymakers are certainly watching the markets and their reaction. We saw that at the onset of the great fiscal expansion that we saw in the early 2010s following the global financial crisis, but we're seeing that now again. So it's a really interesting development. But before we get to that, so how does year-to-date performances actually feed into what you're saying now that you're seeing from a global macroeconomic perspective? Has some of your perspectives changed since the Mag 7 has receded somewhat?
Well, we believe that year-to-date, the developments that we're seeing can be explained by the three drivers of volatility that I've mentioned just now. If we mentally go back to the start of the year, all of us remember the term of US exceptionalism being mentioned a lot, and pretty much it was a consensus trade to be overweight US equities. Fast forward to today, US equities underperformed relative to European equities, for example. And these three drivers that I've just talked about are underpinning these developments. So the first one, policy uncertainty, obviously needs no explanation. Of course, tariff headlines are weighing on US equity sentiment. And I would also make an argument that US policy uncertainty has partly contributed to European equity outperformance too, because it is due to US policy uncertainty with respect to European security, for example, that Germany has announced a historical fiscal defense and infrastructure package, which contributed to outperformance of European equities year to date. The second driver that I've mentioned around difficulty of projecting long-term megaforces into the near term has played out in the US equity markets as well. All of us remember that we went into this year with crowded US equity positioning. We have seen it with global ETP flows, where we saw record inflows into US equities after the US election. And one of the reasons why clients allocated so much to US equities is due to the fact that they were worried to not have Magnificent Seven in their portfolios. Some of the investors that we spoke with were underweight Mag 7 and as a result underperformed their benchmark previously. So into this year, a lot of investors were worried about this repeating once again. So what do we have? We have crowded positioning in US equities due to this AI megaforce, and the unwinding of this positioning at the start of the year has contributed to volatility that we're seeing. And finally, the third driver of sticky inflation, we don't think that the Fed will be able to cut rates as much as many investors expect, because we already have sticky inflation. Tariffs and potential immigration policy changes may further drive inflationary pressures. It may constrain Fed in terms of how many times it can cut. And this is also contributing to the volatility that we're seeing year to date.
Where do you see opportunities specifically in the equity space?
Yes, outside of the US, if we go to Europe first, here we believe the name of the game is being granular, because on the one hand we have positive growth drivers driven by ECB rate cuts and by the fiscal announcements that have taken place in Germany recently. On the flip side, though, we still have a looming tariff risk. So I think it's important in this environment to being selective and focus on exposures that are more exposed to positive drivers and relatively more immune to tariffs. We think that banks is a great example of such exposure. They are relatively more immune to tariffs. They have had strong earnings outlook. They have been great at returning capital to shareholders. And generally, they may benefit from the fact that ECB is cutting rates and there is general loan demand that may start coming through. And I would also touch upon UK equities. We're often asked about which exposures in equity space are relatively more immune to tariff risks. And here, the UK equity beta to global trade has actually been quite low because it's more exposed to services as a sector as opposed to goods. And generally, the UK equity exposure has lower weight towards tech sector, which can also serve as a portfolio diversifier as investors are thinking about outside of tech where else the opportunity could present itself.
Fascinating. And so the, well, if we can maybe stay just on equities, I mean, EM specifically, so is there any other opportunities you're seeing, perhaps India, perhaps in African equities, Latin America? Are there other avenues of equities that you find exciting at the moment?
Yes, so you've mentioned Indian equities. This is our second preferred emerging market exposure as of now. Large caps see earnings stabilization, so we think that we may see an opportunity in that space and in this part of the market. Also, from a strategic perspective, India has a lot of structural tailwinds playing for it. So, for example, the trend of demographic divergence, India is benefiting from growing population, and it's also benefiting from a lot of domestic investors increasingly participating in the market, and it provides great diversification benefits to global equities, even high diversification benefits versus other EM indices, for example, LATAM, and it's not correlated to China. So from portfolio diversification perspective, that can serve as a role of diversifier.
You mentioned on the fiscal side, policy setting being reactionary to market developments. One area where we've seen, policy being set more in, so to speak, isolation has been on the monetary front. So we've seen central banks not trying, at least to be perceived as not being reactionary to market forces, also not caving to political pressures to cut rates. And so, thinking about that and the inflationary pressures on the horizon that you mentioned, where do you see risks and opportunities, specifically in the fixed income space?
Starting with opportunities, we believe right now there is a generational opportunity in fixed income when it comes to income. And this is really important because income can serve as a cushion for a portfolio in both growth positive and growth negative scenarios, and we have run some stress tests to confirm it. And indeed, investors do take notice of this. We have seen record inflows into credit, IG, and high yield last year in global ETP space. Now, in terms of our view, in the US, we prefer quality, so we prefer investment grade over high yield, simply because the tariff headlines, the concerns of investors around growth may impact spreads in high yield space more relative to IG. So that's on opportunities. If I had to summarize it, the biggest opportunity is income. Now, in terms of risks in fixed income, I think this aspect is mostly represented in our rates view. So here we don't like the long end in the US or in Europe because we believe that sticky inflation and high fiscal deficit over strategic horizon is going to continuously put pressure on the long end. So our preference here is towards shorter end of the curve, both in the US and in Europe.
Fascinating. So if we turn away from equities and fixed income, the sort of staple asset classes, BlackRock often speaks about mega trends or mega forces rather. Could you speak to what they are and what you see them as representing opportunities, where those opportunities are from a megaforce perspective?
Yeah, so megaforces are the long-term structural trends that we believe will affect returns of assets on a strategic horizon, but we're already seeing some of these megaforces playing out in the near term, and AI and Magnificent Seven rally is the best example of it. And what we also see that more and more investors are actually paying attention to these trends and incorporating these megaforces in portfolio construction. For example, last year we ran a survey asking clients, okay, what is your attitude towards megaforces? And pretty much everybody said that they're already incorporating megaforces in their portfolio construction and asset allocation. The majority is planning to increase their allocation, and virtually no one was planning to decrease it. So megaforces are here to stay, and this feels like it's a view that's shared by ourselves, but also many investors that we speak with. In terms of opportunities that present themselves, I will probably start with AI, because this is the most topical megaforce that has been impacting US equity markets. So here we strategically like US tech and other AI infrastructure build-out players, but we need to be aware that we're just at the beginning of this trend. AI will be creating winners and losers across different sectors, but it will be happening at different paces. And quite frankly, some of the companies that will be the future winners in that space are either in their infancy or may not even exist yet. So it's really a strategic view that's important to take on this in the space and constantly monitor it and pursue opportunities that are coming up at any given time. So that's on AI. A couple of other examples that I'll mention related to other two megaforces, for example, and geopolitical fragmentation. We're seeing a lot of trends of friendshoring in light of geopolitical developments, as well as nearshoring that we have actually started seeing post-COVID as companies started to bring closer their supply chains. And this is opening up opportunities at country and sector level. For example, we like India and Mexico as countries that are in the middle of these two big geopolitical blocks. And at sector level, this rewiring of supply chains is opening up opportunities across real estate, infrastructure, industrials. And the last megaforce that I'm going to talk about is aging demographics. This is a trend whereby we expect the population to be aging in many developed markets, but also in China. And on the flip side, in many emerging markets, we are seeing a reverse dynamic. And we believe this is opening up opportunities in healthcare, in developed world, for example, in the US and European, in the US and Europe, we prefer healthcare on a strategic horizon. And in emerging markets, we think the countries that can build out infrastructure for this growing demographics and increase labor force participation are best positioned to take advantage of those trends, for example, India, Indonesia, Saudi Arabia.
So how do you square those two, and is there still value to be extracted from a NASDAQ or an S&P 500 cap-weighted index as opposed to an equal-weighted index?
Yes, we think so. And the fact that we have seen a sell-off and underperformance of some of these exposures year to date is actually making the opportunity to access this space at a cheaper level versus what we have seen at the end of last year. And here the most critical thing is exactly what you've mentioned, is the earnings expectations for this space. And actually US tech is, we're having a structural positive view on the sector, even on a strategic horizon within BlackRock capital market assumptions, exactly because these earnings are underpinned by the structural trends that we observe. And obviously earnings is what we keep monitoring to maintain our conviction in that space. To come back to your question around equal weight and S&P 500 standard market cap, so we don't think it's either or. It's more like, okay, now that we have a structurally positive view on US tech due to earnings dynamics that we have discussed, the next question is, okay, beyond that, where else do we see opportunities, especially given that last year the biggest question on investors' mind was, okay, I'm too concentrated in US tech.
So much has been made in US and European markets about sophisticated index investing and how you can actually utilize underlying indices to achieve exposure to a lot of the themes that you've been mentioning. And I wonder to what extent you believe there's virtue in using building blocks to gain exposure to these and build optimal portfolios in order to take advantage of these structural long-term megaforce trends that you're mentioning, as well as strategic positioning to, for example, US tech, fixed income, etc. To what extent do you think a sophisticated index investor might have a chance to succeed in future?
Absolutely. It's so in terms of what we're seeing, we see a lot of investors access the structural trends in multiple ways. There is not one way to do it from index perspective. Some investors prefer thematic, alpha seeking, and index strategies. As we have mentioned some opportunities at country and sector level off the back of these megaforces. Again, from index perspective, there are granular exposures that can provide access to these trends. Some investors even go as granular as creating single line security baskets exposed to those trends. And if we zoom out a little bit and take a broader view on why this granularity may be even more important going forward. Right now, we're in an environment, to our discussion earlier, if we do believe that inflation will stay sticky, and this is our conviction on the strategic horizon, we would be able, in the environment where central banks will be able to cut rates to support growth at all costs, similar to the past when inflation was not an issue. And in the past, what that meant was that when central banks don't pay attention to inflation as much because it's not an issue, they cut rates, it kind of lifts all boats, right? Right now, if central banks will be more constrained in this respect, plus on top of that, if you overlay these mega forces, which will create winners and losers across different sectors, we will inevitably have more dispersion. So it will be more important to take a granular view on what are the winners and losers of these trends. And we believe granularity is just a new mandatory way to construct portfolios to take advantage of the opportunities and maintain portfolio returns going forward. Indexing is a great way of doing it, given that there is a really wide range of different index building blocks that are quite granular in nature that can provide access to these opportunities.
Well, that's all we have time for today. And I want to thank you, Varia, for sharing your great insights and thoughts on optimal investing, mega forces, macroeconomic developments, and more. We look forward to having you back in South Africa and speaking to us again in the future, hopefully. And for all of you dialed in, thank you for attending, and we look forward to hosting you again in future.